what's up guys? Can you hear me? Can you see the screen? Hello. What's up, Thomas? Expo, if you're there, can you just tell me what the quality looks like and whether you guys can hear me? Quality good, and the sound good. All right, cool. Cool. We'll just wait for a few more guys to come in. So, you guys are here because you have, or at some point you've shown interest in the Flash model, you've seen the Flash model, and maybe you have questions. So if you do have questions, now would be the right time to ask them. If you guys are on Twitter and yo, what's up, Silver Surfer? And don't mind sharing the link, you could do that for me, thanks. I would appreciate it. Quality good, sounds good. Okay, cool. So some of my Discord guys are here. This will this won't be anything new to you or for you, but it doesn't hurt having me repeat all of this. Could you quickly go through your story and experience with Kish if you don't mind, of course? Yeah, of course, why not? So I came across Kish just over 2 years ago, and it came at a point in time where I moved away from wave theory for a few months at that point, and I started to dig into ICT, and I started using or looking into price action trading and price action mentors or traders, and one that was recommended to me at first was Chris Laurie, very similar to ICT, and then I moved on to ICT because before all of his YouTube stuff for 2022 model, everything was very difficult to digest, right? And I was still running my Discord, doing wave theory and price action trading, and one of the members inside the Discord recommended me to Kish at that time, and I joined his Telegram, and the rest is history. Now this was at a point in time where Kish's everything that you know, if you do know him, everything that you now see never existed before. All of the concepts, all of the growth, that never existed before. When we were originally there, it was a lot of rabbit holes, and it took some time after experimenting and going down all of those rabbit holes that I started to discard, throw away a lot of stuff that I found wasn't needed or was too fancy for my own liking. And there came a time where I actually even stopped watching his lives because the ideas or thoughts that I had would sometimes be contrary to what he may be talking about or looking at in his own lives, or sometimes he may be looking at a long and I'm looking at a short, or vice versa, and it will just mess with you mentally, right? Because no one wants to fade, quote unquote, their mentor or someone who's currently teaching them. So I moved away from watching his lives, still carried on with a lot of his videos, and what's up, Jess? And I think at last year when my dad got very ill and had to have a bypass surgery, I took some time off his Discord and just trading for quite a few months. I didn't have time to actively trade or learn, and when I got back, using all of the knowledge that I had, I decided to strip everything down to bare bones, remove all of the things that, while they look good on paper and they look fancy and good for socials and all of that, they weren't needed, right? They weren't needed. So that's where Flash was born. That's where Flash was born. And Flash came, if you've watched the previous video, Flash is actually a little inside joke, because you know the model Kish has. A lot of you by now know the model Kish has is Zoom, right? Which looks like the standard or the very public reversal pattern, right? You have some sort of accumulation, you have a failure swing, you have an opposing liquidity run, Judas, manipulation leg, turtle soup, and then you have a dealing range being created with displacement, you have retracement, and then you have expansion. And this was good. I still use this reversal fractal right here, but there were times, and you notice that there are times where things don't play out. Things don't play out the way you want them to in terms of Zoom, where we get this Judas or this manipulation leg. There are times where price just goes into a level, does something like this, makes a lower high, pushes below, retraces, and then expands. So this is where Flash was born. And it's called Flash because Zoom is actually a DC villain who's also a speedster, and Flash is sort of his opposite or counterpart, right? So that's where Flash came from, the name Flash. It's a DC joke, Flash and Zoom. Opinion on Anne. I lost a lot of money. I saw you were using them. Yeah, Anne, Thomas, Anne hasn't been 100% on point as of late. I still, my guys know in the Discord, I still use it as a daily bias. But it doesn't necessarily mean that if Anne is bearish or bullish, that you're going to blindly buy or sell, right? You move beyond that. Anne's a nice tool to use, but you don't blindly long or short just based on bias. We do that on structure. So Flash was born out of a need, and that need became or was born out of the absence of a higher high being created or a lower low on this reversal or entry fractal, and where we actually had a lower high being put in, a lower low, retracement and expansion. This is where Flash was born, out of a need of not wanting to miss any entries and being able to identify when market structure shift has occurred. And if you know classically, ICT's market structure shift in this particular model or piece of price action would occur when we have that initial displacement, we have a retracement or series of up candles, and then we close or trade below the initial displacement right there. This is where the MSS would occur. And when you dig deeper into things, you realize that order blocks being created, such as these series of up candles that get validated once we close below the range like that, especially if these order blocks have taken liquidity on the way up here. These order blocks right here, as we start to, in this case, close below lows to the left, this order block is where your focus should be, right? Originally, you would probably have something at the top here, and in an ideal world, you want to see 50% of the mean threshold of that order block, which led to the initial displacement, being tagged, and then price to close below this low right here, and we then shift focus to this range that was created right here. So this is where Flash came about, and this is what Flash is about, right? And if you break it down to bare minimums, Zoom would be breaker logic, and Flash would be mitigation block logic. That's just the essential, the essence of what they are, what it is. But being able to identify Flash in terms of when we start to close, and the keyword is close below lows, you shift your focus to the most recent order block created and look for retracement into that order block, and that's where your setup should form. Now, when we talk about order blocks, I had to create filters for them, right? I had to create filters for them, and if you watched the previous Flash video, you would know that my MSS, or change in the state of delivery, is a much slower or later version of what the currency merchant Kish or ICT would call CSD or market structure shift, right? Kish being the most aggressive, ICT somewhat in the middle, and mine being the most delayed. And the small differences or the differences then become, whereas the currency merchant, and this was one of my original models, right? The CSD model, an order block that forms in liquidity, gets traded through, validates it as an order block, retracements are for entries, right? That's the currency merchant change in the state of delivery, or order blocks forming in liquidity. Whereas ICT would not just use the most recent order block that formed or closed below or inside liquidity. He would use the entire series of order blocks, right? So if there are two candles, and if you're using the entire series of order blocks, ICT's change in the state of delivery occurs at the opening of that series of order blocks right here, and all he requires is a wick through that opening of that series of order blocks for his change in the state of delivery. Now, both of these ways have got me into trouble in the past, so I had to create an even more solid approach to defining, for me, market structure shift. You could use the currency merchant version, which is aggressive, form an order block, trade above it, change in the state of delivery, retrace long, right? You could use many ideas or theories, like any FEGs that form here, bearish FEGs forming, we close above it, market structure shift. These FEGs should now contain price, as price has flipped from fair value for selling to fair value for buying. And these things are not random, as you can see, as you draw them out in time. But for me personally, I had to create even more stricter rules or filters for myself. So this is where after we've able to identify an order block range, there had to be extra filters for me, and that basically came from looking to the left, right? We can't always look to the right or the future for price. We're always looking to the left. So at any point in this move down, I'm always looking to the left. This high, for example, would have been something I would have been interested in if there was any trading through it. This high right here, and lastly this high. Now I don't want to see wicks through the highs here, and I don't particularly care if the highest high in this up candle range from this low to this high, I treat this as an up candle range, even though the lowest wick is from a down candle and the highest wick is from a down candle. That's the range or the reference that I'm using for market structure shift. For me to actively engage in any reversals, I'm going to need closes above the highest point to the left. And that only occurs if you look at it with this candle right here. Once we put this candle, print this candle right here, it's game time. All we need to do, and if you can see, this is the classic reversal zoom type of pattern or fractal. All we need to identify then is body to body, the order block range, which is these two candles, body to body, draw it out in time. That's step one, right? And you don't randomly, someone asked, where do you look for zoom, at random levels or at specific levels? You can't look for these things at random levels, because if you saw the tweet that I posted today with all of those 8 steps, reversals don't just occur in the middle of nowhere. They shouldn't. If you see something occurring in the middle of nowhere, it's probably liquidity engineering, and those stops would most likely get, or those lows would most likely get run. So when we're looking for any reversal to occur, they would have to occur at some high time frame point of interest inside a liquidity pool, which could be a previous order block range. Unmitigated order blocks. I'm a big fan of unmitigated order blocks because we would be looking, just give me a second, we would be looking for price to reverse from them, right? So every time we put in any order block range, I'm always, if we don't mitigate them, meaning once we put in a range and we close above it, I want to see price trade back to it, and ideally to the mean threshold of that range, right? If we just carry on pushing up higher this way, there must be a time where price retraces back into that range. You draw it out in time, right? So those become targets for us for any movements to the upside or downside. And then of course, the beloved Dexter fibs, when we are able to identify a leg that has taken liquidity and we project said leg or that leg, you can see that at 2 to 2.5 standard deviations, we expect things to happen. So at 2 to 2.5 standard deviations, I'll start to look for that reversal type of fractal. And when it does show up for work, you can't not take it, right? So this was my long entry yesterday. And we can split it up into 2 right here. Let's do that. Whoops. Let's do that, right? Left side M5, right side we'll go to US 100 capital.com and we'll make it M1. Right, M1. Get rid of this. And I think it's down here. Right, same piece of price action, 2 different time frames, left side M5, right side M1. So at this point on the left side on M5, the filters start to play in after you are able to identify the order block range that has occurred. Once we validate that order block range, start closing above highs to the left for my MSS. We can then engage in any retracements in order to go long. And the filters that I've created is, number one, if you identify the order block range, are there any imbalances in the range? If there are imbalances in the range, we would look to trade the imbalance, but at all times we are also, and more so, looking to trade the mean threshold of that order block range that we've just marked off. So in this case, you can see there's an imbalance inside here, but the mean threshold is what we're looking for, right? And as price starts to move higher and higher and higher, we made an initial move up. There's the high. We had a retracement here. Price started to close above the highs to the left. We shift our focus from, especially if this is mitigated, from this OB range to this one right here. We could take it wick to wick, body to body. That depends on you. Again, are there any imbalances in the range, or 50%? This is where we would be looking to trade, because a lot of flash and order block range theory relies on the fact that if we are bullish or bearish, right? If we are bullish, we want to be closing above down candle highs, and any retracements should be restricted to or limited to the previous order block range that we just left. It's only when we start to trade below the lows of down candles like this that reversals or market structure shift occurs. So as long as we aren't trading below the lows of down candles or order block ranges or previous order block ranges, we're good. You can see that at no point inside here that we have traded below any down candle ranges except up here, right? Once that starts to happen, it's go time. Until when? Until we start to trade above up candle highs in this case, because we are now bullish. There's a range formed here, an OLR. We close above it right here. Same story, retracement, expansion, right? So the simplest model would be this side, you're looking for reversal, classic reversal pattern. If we start to close above highs like this, then you would be looking for retracements inside the range to go long, because your bias is now bullish. On this side, it's the same thing. If you're looking at M1, in this case, this would be the high that I would be looking for to close above. But if you look here, we put in this movement up, this retracement, and then we pushed higher. So we went from a low to a lower high to a higher low and a higher high, right? This is now what the flash is about, or mitigation block ideas. Identify the mitigation block or the flash or OB range. Once you identify it, are there any imbalances in the range that are visible or clear? If they aren't, trade the opening price. Opening price of the range or 50%. Does that make sense? So you can see to the left, we may have used zoom or classic reversal type fractals inside here on an M5. On an M1, there's your flash right here. That's flash. It's also why I called it flash, because you notice it does that. It's like a lightning bolt. Same story here. Once you start to retrace, and we are now closing above highs to the left, market structure shift occurs. Identify the OB range, body to body, highest body to lowest. Ask yourself the question, are there imbalances in the range? If the answer is yes, trade the imbalance or mean threshold. aka 50%. There you go. That's it. Look what happens after. Now, my guys in the Discord know that we use with this, we complement this with other specific points of interest in order to identify where exactly buying or selling should come in. But at the essence of all of this, classic reversal type fractal or the flash model is being able to identify an order block range, identify if there are imbalances in that range, and if there are imbalances, trade the imbalance. But we are always looking for that order block that has been validated to mitigate 50% or the mean threshold of that order block. If they don't and they start to move away, that creates inducement. And more than likely, if they did something like this, not mitigate 50%, move away, most likely these are the times you see something like this happen. Take this as liquidity, mitigate 50%, then start moving. Right, are you guys still there? No one seems to be talking. So the base of flash or zoom would be understanding order block ranges, when we get bearish, when we get bullish, where to look for reversals, yeah. So Zenith, you know the thing about stop losses, especially if you watch the charts long enough, you'd notice that while there may be an initial tap into an order block range, for example, right? I'll give you an example right here. Let's look at this range right here. Let's say this was your initial order block range right here. We'll make this larger. On this time frame, we closed above it here. We tapped back into the range. This is your first tap. We move away, and notice how more often than not they come back for that second tap. So when you move your stop loss, you risk them coming back for your stop unless you've taken profit or partial somewhere here. So just watch the time frame that you are using, because an M1 may not be it. This on an M1 may have just been this on an M5, where it looks like this is the retracement back and then this is the expansion. But on an M1 it looks like we expanded above, we tapped once, we shot up, we tapped again, and then we shot up, right? So just watch that. Where then do you expect breakaway gap if you're always looking for mitigation? Now, if you understand what breakaway gaps are, then breakaway gaps should occur above highs or lows that have taken liquidity. In the simplest sense, if you have this high being taken right here by this movement upwards, right? Because this has taken liquidity to the left, you don't expect there to be liquidity above these highs right here, which means in your head you have to be thinking that breakaway gaps or speed should come into the market once we start to close above these. You should start to see breakaway gaps form. So above highs or above lows that have taken liquidity, that's where your speed or breakaway gaps should ideally form. You should also understand that once, and if you can let this specific piece of information sink in, you'll be better off with your entries, because after any high has been traded through or low, but in this case a high, there should be some measurement of retracement. So if you just hold back on spamming that buy button, once we close above the high, you would get a better entry if you wait for that retracement. So when you start to incorporate Flash and the order block model or order block range model, all we are doing or looking for is ranges to be created in one direction. If it's bullish order flow or bearish order flow, in bullish order flow we are waiting for down candle ranges to be formed, price to close above those down candle range highs, especially if these down candle ranges have taken liquidity to the left, making them a proper order block by definition. Where an order block has taken liquidity, we have displacement, it then makes those order block ranges or the lows of those order blocks protected, right? Means we shouldn't see any closes of price below that range that we just created after we've shown willingness to close above it. Once you see closes above a range high, look for retracements. They can wick the low, they can wick it. That's why you don't put your stop there, you put your stop here. Once you see closing above a range high, these are where your entries form. Retracements into the order block range that you've just validated or closed above. These lows become protected until or unless we start to trade below the lows of down candles in bullish order flow. Make sense? Every time you create a down candle range and we close above it, retracements are for longing. Same story here, retracements are for longing. Close above here, you look for retracements to start longing, and then you add the filters that I've just described for you. Are there any imbalances in the range? If the answer is yes, trade the imbalances. If you can visibly see any imbalance in that order block range that you have just now identified, trade the imbalance or mean threshold. These are not random things that occur when price comes back to mitigate 50% of the previous order block range. Close above a high, retracement, there's your order block range right there. There's imbalance inside the range right there. Not random at all. Make sense? Let's have a look at more questions here that I may have missed. HGTA. So the Discord, I've got a good set of guys in there, and one of my guys runs a group call daily, either maybe 3 times in the week he's running a New York call, and twice a week he's running a New York PM session. 3 times a week he's running a New York AM session. But the purpose of the group is not for signals or give any live calls. It's actually to teach. It's always been to teach. My analysis is in there every day. I try and update at the beginning of the day. My expectation for the day is already planned out, and I adjust accordingly as the day moves on. I do run a group call myself weekly, or if I see fit or need to express something or convey something, I do a group call myself. So there's a lot of streams and past content in there. So it's not only the 5 minute or the M1 or H1 H1 should be your go-to, right? And when I say go-to, it means all of your levels that you have or are looking to trade are going to be based on H1 or a daily candle. So let's touch on something that you see a whole lot of happening on Twitter, especially with CRT and a whole lot of CRT, all relabeled logic that has been in existence, and I know for a fact was taught by TCM. So candle range theory and turtle soup and all of that, that's all nonsense, relabeled logic for me, right? And you don't need a university of turtle soup with a whole series of videos to understand that logic. And the basic premise of that logic I'm going to show you now. I'll show you today, right? You could start on a weekly like I usually do, and it becomes a very simple concept, right? I'm going to show you two very specific concepts based on turtle soup, and one is going to be what he calls CRT, candle range theory, and it's actually something that I use or call an algorithmic draw. And basically what that entails is, and you could reverse, or we'll look at this, right? When we wick above highs, expect lower pricing. When we close above highs, expect higher pricing. When we wick below lows, expect higher pricing. When we close below lows, expect lower pricing. So closing above a high would show you willingness to go higher. Closing below a low shows you willingness to go lower. Wicking above a high shows you that it's not really ready to go higher, or wicking below a low tells you it's not really willing to go lower. And what you actually need to realize is, where would the algorithm draw to after those wicks occur? And the answer is very basic. If you have a level on your chart and you see a wick above it, time frame doesn't matter, whether I'm using weekly, daily, M1, M, whatever time frame, right? Even seconds. When we wick through a high and fail to close above it, the algorithm is automatically going to draw to the low of the candle that wicked through that high. You see this? It's not random. When we wick through a low, the target becomes the high of that candle that wicked through the low, right there. You could go back onto any time frame, any time frame. Look at how price has been wicking through highs or lows. Wick through a high, draw to its low, right? Go back and look at all of this. Wick through a high, draw to its low. Wick through a low, draw to its high. It's the same thing over and over again. Are most of you familiar with the concept, or have seen something like this, or haven't seen something like this? This is where your targets or projections can come from. Because if I expect this on a weekly to be a drawn liquidity for me, when we fail to close above this high, I'm immediately looking for price to draw to this low. Or if we fail to close below this low, I'm looking for price to draw to the high of the candle that failed to close to this low. So that is basically, in 5 minutes, what quote unquote candle range theory is. Now there's another very specific model that I've shown is basically when we wick through a high The target for me, firstly, would be the low that created the high, and secondly would be the low that created the original range high that we wicked through. Again, when we fail to close above a high, target 1 would be the low that created the failure to close above. Target 2 would be the low that created the original range high that we failed to close above. Very simple. And this is where turtle soup ideas come into play. We turtle soup the high. We target the low that created that turtle soup. We target the low that created the range high in the first place. Go back and test this on any time frame. It's why, and my Discord guys will tell you why they we were so confident. Why I was so confident when we wicked this high on the week of the 18th that price is going to draw here and going to draw here, and every single move inside here we were looking to position lower. Can you show the difference between yours and ICTC, the CSD again? Yeah, sure. This is something you should already know though, right? Let's go. For me, MSS or change in the state of delivery needs to occur when we close above a high, right? Close, keyword. ICT just requires trading through the series, the opening of the series of order blocks. So just a wick through would be CSD for him. For me, I want to see closes above that specific level. So that's the difference. Can you show some of your losing trades? Yeah, I don't know. I haven't. I could show you one today, but I don't think it was a losing one. It was getting stopped out at break even. I was long inside here on the news data. I did get stopped out on this one down here and had to re-enter. So long inside here, price came down here, I was driving, not paying attention, got stopped out here but re-entered inside here. You guys must remember that once you are able to identify what market structure actually is, just look at this on the M5. What would you guys say is the very first step? And my guys already know this. What would you guys say is the very first thing you would look at when you decide to take an entry, especially at a high or low that you think is a high or low or point of interest? What would be the first thing you look for? That would tell you, in order for me to engage in looking for or be contrarian or look for a trade in the opposite direction, I need to see this happen. What would that answer be? I use capital.com, Skellen. Time and displacement. Yeah, you haven't seen me talk about anything about time here, because in all honesty, while I don't negate the fact that time plays an important part, I don't rely on time. Yeah, quite a few of you got the right answer. So we need liquidity taken or stop hunt, right? In order for you to engage with anything, you need a Judas, you need a manipulation leg, you need an OLR, you need a turtle soup, right? That's all that you need. Once you have your point of interest and you have that Judas or manipulation or whatever you want to call it showing itself, you then need to see where the market structure shift has occurred. Now, if you take the example that I showed you all the way down here, standard deviations showed us that this was a possible area for reversal. But if you are looking for reversal, and I'm going to answer your question, Vinayaka, that if order flow is bearish, any up candle range that is created is done so with the purpose of driving price lower in the direction of order flow until the objective is met. Right? Any up candle range in bearish order flow is created with the purpose of sending price lower in the direction of order flow until the objective is met. You may not know what the objective is. You may know what the objective is somewhere down here. It's a liquidity pool, it's a failure swing, it's something down there. What do you notice in every single one of these candle ranges, up candle ranges that are being created? What do you notice? What do you notice in bullish order flow in any of the down candle ranges that are being created? The simple answer is when we are bearish and we create a series of up candles, you know from classic ICT knowledge that once we close or trade below a range of up candles, it validates those series of up candles as an order block, making it a bearish order block. Create a range or series of up candles, close below it, they become bearish order block. Same here, same here, same here. Do you notice that in bearish order flow, every range that we created and closed below did not trade above the previous range's high in terms of closing? It did not close above the previous range's high until when? Right here. What happened afterward? Retracement, expansion, reversal. So if you are bearish, every range that is created is done so to drive price lower in the direction of order flow until the objective or your point of interest is met. And instead of trying to long every push up that you think is a reversal, why not draw the range out in time, look at 50% of that range or any imbalance inside that range and take your entry there. As long as your ranges are being respected, look at here, this is all bearish order flow until we start to close above Vinayaka, until we start to close above the highs of up candles. See where that comes in now? Until we start to close above the highs of up candles to the left. In bullish order flow, what do you notice here? Every range that is created is respected. Create the range, create the range, create the range. Until when? Until we start to trade below the lows of down candles to the left. So if you are able to see a down candle to the left being closed through, there's a two down candles, a range right here. When do we close through it? Right there. If you can see that and it is validated as an order block from the lowest to the highest, that's 50%. That's not random. But every time before that occurred, we never traded below the lows of down candles until an objective was met. Alistair, an objective would be any point of interest or target or take profit level that you deem fit. Maybe it was, let's just take this current example. Maybe it's a Dexter fib projection like here, and you are targeting 2 to 2.5 standard deviations, 3.5. An objective is if you are looking for reversal, or it could be buy side liquidity, it could be sell side liquidity, it could be a liquidity pool. That's your objective. Objective is where you think price is headed to before it turns around. That would be the objective. But it's not just where you think, right? Because the market doesn't move on my thoughts or your thoughts, right? The objective would be where the market needs to go or feels that it needs to go, and then give you a dealing range after an objective is met, give you a dealing range, retracement, confirmation, expansion. You see that? You don't get a dealing range unless you see the objective being met. Everything else is just a range created to send price higher to the objective. Does that make sense? So it's very important that if you are bearish, that the highs of up candles are not closed above. If you are bullish, the lows of down candle ranges are not closed above. And you would then use those down candle ranges in bullish order flow and those up candle ranges in bearish order flow to contain price, to send price lower towards the objective, or contain price and send price higher towards the objective. Does that make sense? Has that ever been a thought that has occurred for you guys, or are you of the opinion? Because the epiphany for me came where I was always looking to short, specifically shorting, and every time we went above a high, I just wanted to short it. You may get an initial reaction, it stops at the previous order block range, a protected low, and then it just F's off up again. And then we close above another high and I want to short. And then it just retraces a little bit into the range and then it F's off again. So instead of trying to look for reversals, try and look for continuation on every range that is created until the objective is met, until a dealing range has been formed where we've taken liquidity to the left buy side and then sell side. Look for the retracement and then the expansion. Then you move into bearish mode. Create up candle ranges, close below them, any retracements back into them. Use the filters that I've just given you, 50% or any imbalance inside the range. If there are no imbalances, trade opening price, short. Does that make sense? So you are only looking to engage with price or give you confirmation when you see that a high time frame point of interest has been met. In this case, we start to close above the highs of up candles to the left of price. because we haven't done it here, we haven't done it here, we haven't done it here, we haven't done it here. Why are they starting to do that now? Identify your order block range. Are there any imbalances in the order block? Trade the imbalance of 50%. We get expansion happening again, closing above down candle ranges, retracements back into that range, should be for longing. Create new ranges, retracements for longing, so on and so forth. Sounds easy enough? Starting to fill in some of the missing pieces for you guys? Yes, no? You can truly see the power of Flash when you notice that we had a drop down, we had a lower high being put in like that. Are there any imbalances in the range? If there are, trade the imbalances right there. That's how it works. Initial expansion, retracement, confirmation by closing below. When we close below the lows of down candles, it's telling us it wants to go lower. Retracements are for fading. Yeah, if we don't mitigate the OB range immediately, it leaves it open. Like I said, look down here, for example. We had this right here. We had the range. Let's do it out. Let's draw it out a bit better for you. Right. Say I took this as my OB range on this particular time frame. Notice, I'm not interested in this immediate push back into 50%. I'm interested in the range being created, and at some point we come back to it and then we move away. I'm not interested in immediate pushes into the range before we move away. That immediate push is fine. It'll be used as liquidity to be taken later on. I want to see price push away from it and then come back. So when we don't mitigate these ranges like this, they become targets for me later on, because price will move from order block to order block, right here to right here, until one of these will give. We may have a situation where price holds in here, retraces back into this flash range or order block range, and then falls off a cliff. So always looking for mitigation of those order blocks. Zolan, I'm not sure how you know about the pigeon model, but I don't think I want to share the pigeon model. Is not for, it's time based, but it's not for this YouTube. Not for this YouTube live. Those are things that we cannot talk about on this platform. What other questions do you guys have? I don't do these often, so you better ask all of them now, because these are fewer and far apart. And honestly, and my guys will tell you that we are a little bit more advanced than what I'm showing you with these flash and OB ranges now. There's a lot of other things that we are currently using in conjunction with the flash, because my guys would know why this level or even this specific candle right here would have been a short. Is every swing point a dealing range in itself? I wouldn't say every swing point is a dealing range in itself. I like to think about every range that is created until an objective is met is a trading range, and once the objective is met and we take buy side and then we go for any sell side liquidity, say we push through here, this is where the dealing range is created. The dealing range is created when it houses both sides of opposing liquidity, buy side, then sell side. How do you time frame alignment is not a difficult thing. I mean, you could use M5 M1, you could use M5 H1 H1 daily. Those are the only time frames that you would need to trade. Remember, all you are looking for, you could go, let's take a look here, right? You could go, the model is universal. Of course, the model is universal. The model doesn't require a specific time or time frame. And if you don't believe that the model is universal, then let's take a look right here. This is a 1 minute chart. Liquidity taken. We close below the lows of a down candle range. Close below. It gives us this low to that high as our dealing range. If there are any imbalances in the range, you trade the imbalances right there, or 50%. So in essence, you could have a situation where you could put an entry at 50%, stop just above the high, and target some low to the left. If you don't know what that low is, put on the good old Dexter fib like that. Target 2 to 2.5 standard deviations. Let's just say 2. 2 is the lowest hanging fruit, and that's your trade idea. This would have given you almost 40 points. How would you have applied the flash model or any of the logic to today's GBP USD? Let's take a look. Let's not guess. You can take a look. And what are we looking for in how would you have applied the flash model to today's PA? So this is Friday's PA, all of Friday's PA. Where would I have looked for my model to show up? I would have looked glaringly right here, right? Alternatively, you could have looked at this little example inside here, where we closed below the lows of down candles right here. Take this range, look for any imbalances in the range, wherever they may be. Could be all the way up here. That's an entry. But if you miss those, and often you may miss those because of New York Open, happened right here. It's simple. Close below the lows of up candles. This becomes the range that I'm interested in. Are there any imbalances in the range? Yes, there are. Trade the imbalance. See that? In this way, and notice how 50% of this order block range was not mitigated right here. So where do you think this is going to come for? It's going to come up here. The model is everywhere if you find it. You could look at, not a Forex fan, but if you are able to identify any order block ranges before we start to close above price, close above highs, any order block range created before the close above. Are there any imbalances in the range? Yes, they are. Trade the imbalance. I wouldn't start with the M5 on a GBP USD if I just started because I don't know where this is going or what this is doing, right? I don't know. All I know, we had a big drop here. There's imbalance inside the range all the way up here. I'm ideally looking for this to start rebalancing at some point all the way up here. So you don't start. You could start on the daily. Now you see this on the daily. I don't know if this is or was a point of interest right here. Let's get rid of this. Let's get rid of this. Let's get rid of this, right? We are starting to trade or close above up candle ranges right here. So if this was a range that I was interested in, it's come into this imbalance inside here. It's starting to close above up candle highs to the left. I would look ideally at any retracements that come back inside here or 50% to go long. What does that look like on an H1? It means that I would be looking for any retracements back inside here to go long. Any more questions you guys have? Keep them coming. What are those burning questions that you have? So what have you taken away, if anything, from today? You don't engage with price until liquidity has been taken. You wait for the highs of up candle ranges to be closed above for bullish reversals. You look for the lows of down candle ranges to be closed below for bearish reversals. You identify the order block range and you look for 50% ideally to be mitigated. Or any imbalance in the range, you trade the imbalances. I've already gone over the 3 variations of CSD. My biggest issue is seeing a displacement at like New York Open and not being sure if it's just a retrace. Saba, which one in particular? Today's New York? Price trades between OB and OB until one side gives here. So today in particular, Saba, my draw was above here, this high put in overnight. Because while it may have come into this H1 level that we had marked, I don't want to see a reversal just happen on PA that was put in overnight. I want to see New York take that high and then show me it wants to go lower. Even when the news came in here, you know the model, the data low and the data high, which is the news high or the news low, take one side, target the other side. Always the case. Take one side, target the other side. In this particular case, we were bullish here today. So any pushes down after we've taken the data lows, here is where you play. You play inside here. You may miss it because price moves pretty fast. Flash model can be used for any asset. Of course it can. Flash model is an understanding. Yeah, of course you had imbalance below. Of course you would have had something like that. But remember, price action that looks like this is not bearish. Retail logic would say that's a bull flag. So very important, even if you have to up your time frame, use a M15, use some other time frame, right? This is what is important to take note of. When we close above highs, it validates the previous range as something that should be protective or protected unless the objective is met, which means these lows should be safe. We can wick through them. Market structure shift would be if I turned this around like this. Would you not say that this is the range of up candles before this move down, and if any closing above here is where you would engage with anything, right? That's a classic zoom kind of setup. But if you notice what's going on here now, we had this push, this lower high in this case, and now we are pushing upward like this. When we close through this level, it's a market structure shift and it's a flash range right here. That means whilst we may close above this swing point to the left, I'm going to look for anything that comes back in here to do that. To PAs AMD and went short PA this morning. Go to any time frame you so choose. Choose any time frame. Different people have different requirements of what they look for daily in terms of points or dollars or pips, whatever it is. Go to any time frame. I'm telling you that flash, understanding of flash is it's an understanding, right? It's exactly that. This is a 15-second chart. If you understand that price moved here, here, and then we made a lower low, is this not the flash range right here? When we understand that and we identify it and we are able to mark it out in time and price like this, and if you apply the filters that I've given you, if there are imbalances in the range, trade the imbalance. But I limit that imbalance to only the portion that is inside the range. There you go, right here. Still afraid to take that? Start closing below lows again. Shift your focus to the new range. Are there imbalances in the range? Yes, there are, right there. Still afraid? Shift your focus when we close below here. Are there imbalances in the range? this tiny little imbalance that I have my finger on right here. Still afraid? Create an up candle range, close below it, retrace to imbalance. There's your imbalance. Fade. This is a 15-second chart. So you understand now why I tell you that price is truly fractal. The time frame does not matter. Understanding structure, yeah, that matters. These are not random things. When you start to see them, you start to see them. Flash. Why? Lower high, lower low. There's your flash range. There's imbalance inside the range right there. Not random. What is the level you mark fair value? I'm not sure where I marked that as fair value. It's just a failure swing high. That's all that I can tell you right now. Can't get into specific on that one. It's just an area where price is considered to be premium or discount, or discount if you're longing, or premium if you're shorting. Fair value for buying or fair value for selling. Right, I think I'm going to start rounding things up now if you guys don't have any more questions. I've gone in detail about Flash. I've spoken to you about structure, when you are bullish, when you are bearish, what to look for. Again, if you're bullish, every range created is done so in the purpose of sending price higher. And it's not until we start to close below the lows of down candle ranges that we become bearish. And when we bearish and we start to close above the highs of up candles, that's when we look to become bullish. All of these have to coincide with a high time frame point of interest or liquidity pool of some sort, where you are logically expecting a reversal to occur from, and not just anywhere random in the middle of a range. No one is asking you, and I didn't, my guys know, while I may have caught this low all the way down here, I came out at about 3.5 to 4 standard deviations right here last night before I went to bed, because I wasn't willing to hold through earnings. Am I sour about it this morning when I woke up and saw this? Yeah, of course, I'm sour. I am. But this could have went the other way. I would have been bitter. So, logical area, I expected a reversal to occur, and I was out of there, right? I'm not about holding, no matter what happened. What other questions do you guys have? I have given you more detail and insight from the last Flash video, which was the introduction of Flash. You now have deeper insight or understanding, especially if you start to incorporate what these people are calling candle range theory. When we fail to close below lows, the algorithm will draw to the candle's high who fail to close below the low. Just like this guy right here, news high that failed to close above there, that's your target right there. these are creating points of interest or targets for you to hit. I mean, you can't hit anything if you don't know what needs to be hit, right? How you found the starting point high time frame? Well, what do you mean? How do I find a starting point? Look here, pretty simple, right? Forget what you're seeing on the charts right here. We'll just do this again. Go to a weekly. Or was that a daily? Let's go to a daily. Right. We put in a series of down candles. We then put in a series of up candles or retracement. We close below there. It's telling me it wants to go lower. All I'm interested in, if I am bearish, and I know I am bearish because we've closed below this low. Look there, 50%. So once we close below, we're looking for any retracements back to 50% or any imbalance inside the range, which also includes volume imbalances, because volume imbalances are a thing. This needed an down candle to print inside there. There you go. And as you start to close lower and lower and lower, you keep doing the same thing. The fact that we've closed here below these lows, my expectation is that any retracements inside this range that we just left, any failure swings to the left of this high, these highs, this high, all come on the menu. All you need to do is then just start drilling down to lower time frames and lower time frames. That's all. The market doesn't reverse from V-shaped reversals like this. This is one form of reversal. V-shape, pump into a level, immediately push away. For me, I want to see the classic reversal like that. Or occasionally you get the mean or nasty type, which does the 3 drive into that level. But ordinarily, I don't want to see V-shapes. I want to see classic reversal type, and I hate when they do the 3 drive into the level. But those are the only 3 entry types that you look for or trust. So in the absence, if you look here, if we aren't trading above down candle highs to the left, up candle highs to the left on any range that is being created, all of these were just for shorting. Look at even this range right here. It's flash because we put in a lower, higher low, and then a higher high. This is the flash portion of it. That to that to that. It makes this the flash range. It makes this imbalance an entry. But it also means that this 50% or mean threshold that has not been hit is a target, especially if this drop down, or when this drop down here didn't touch this 50%, this low is inducement. This is going to be used as liquidity. I want to see something like that happen. These are how ideas are formed, and biases and targets. All right, that's it for me tonight, boys. 1.5 hours has gone by pretty quickly. This will be automatically available on YouTube. I'll post it'll be on my YouTube page. I'll post it on Twitter and everywhere else. And I appreciate all of you guys that have come through today. And hopefully we can do more of these going forward, maybe once a month. No problem, James. K, Sawa, Doc. No problem, Money Lisa. That's a good name. Nice pick. Money Lisa. Please share what is on your Discord. My Discord has one main room where we chat in. It has a course channel with course videos in it. It has a stream channel with hundreds of videos in it by now. It has an intraday channel where I post all of my intraday thoughts or ideas and solely on NAS. We have some of my other guys have their own channels. They run live calls as well. So yeah, always updating as things happen. I have now migrated to WAP as well. So most of the access automatically gets given or done on WAP. I'll include a link when I upload this or when I edit this video. I'll include a WAP link. So once you click the link and go through the portal, it will automatically give you access to the Discord. Let me just check something quickly before we go. Give me a second. My Discord inside here. I didn't save it. Yeah. Alright, then I'll catch you guys. I'm going to end the stream here now. In 1 minute, it'll be exactly 1.5 hours. I don't want to make it too long. People who are rewatching this will start to get bored and drop off. So thanks again, and I'll catch you guys on the flip side.